Is the stock market in a bubble? And what about artificial intelligence with the fabulous stock market valuations of NVIDIA, Google, Microsoft, and more? And what about Donald Trump's choice to run the Federal Reserve? Are the markets worried if he appoints a pushover for lower interest rates?
From the opinion pages of the Wall Street Journal, this is Potomac Watch.
This is Potomac Watch, the daily podcast of the Wall Street Journal. Opinion pages, and I'm Paul Gigot. And my guest today, Andy Kessler, visiting us in studio from his abode in California. Andy writes the Inside View column for the Journal and is a former hedge fund manager who follows the financial markets and Silicon Valley for us. Welcome, Andy. Good to see you here in the flesh. Let's take up the overall economy first. I mean, how are you seeing things? ADP jobs numbers this week, not good, down 30,000 or so. So the job market a little shaky. Unemployment rate's still not that high. I think it's 4.6 nationwide. Higher in your home state. Right. But the stock market doesn't reflect it at all. So how strong is the economy?
It's a mixed bag, I think. I mean, you see layoffs happening in a lot of places, and I think, the number one job is for people that can plug NVIDIA chips into boards and then into data centers. I mean, the Journal suggests that half of economic growth is coming from building data centers. Now, whether we need all those data centers is a bigger question, but in the general comment, manufacturing, I read this morning, is heading down.
Yeah, it's been in recession for some time.
Yeah, so you get this mixed bag. I don't think tariffs help. That adds to confusion and uncertainty. And so, sometimes the best markets are when the economy is not growing too strong and there's fears of recession and the Fed needs to cut rates and that keeps the market buoyant. But at the end of the day, the market's driven by price to earnings ratio. And unless you have earnings, no matter what you multiply by that price earnings ratio, if earnings are going down, this market can become a little iffy.
Yeah, the labor market for a while has been kind of blah. And I wonder how much of that might be AI, which they've been worried about for the long term, affecting job growth. I think part of it is policy, particularly on tariffs. Yeah. The Fed choice is something like that. But the sort of the big beautiful bill passed, but we still don't know what its overall impact might be. And a lot of businesses, you talk to CEOs, I do, you do. What they say is, well, we're holding off.
Yeah, I think the AI job disruption. It's a little early for that. I mean, you hear Facebook saying, well, we're not hiring anymore because AI will do half of our coding and the like. But in corporate America, there's still some reluctance. I mean, one of the problems is AI still hallucinates. Now, hallucination is such a great term because it must be someone else's fault. Because
now, explain what hallucination is.
Well, hallucination is when you ask AI a question or you have it. You do a prompt or a query, and it's just the wrong answer. And
they make it. Sometimes they make it up.
It just makes it up out of whole cloth because it's a statistical system. So it says, well, what's the next best word? It's very good. I mean, the AI revolution. It's a productivity powerhouse. It's wonderful long term, but near term, it still makes mistakes. Now they call that hallucination because that sounds not as drastic, but I look at it and go, no, you're wrong. So enterprises are still reluctant to use it for customer service and things like that. Salesforce has their agentic AI and it's growing. They say it's now a $500 million business and growing like a weed. And that's great because there are certain areas where you can use AI to do the frontline customer service. So you don't need to hire. Now, that wasn't necessarily hires in the US. It might have been hires at call centers in India and anywhere else. So I think it's going to take another 5 years before corporate America really says, okay. I mean, even personal computers didn't make their way into corporate America for a decade. I mean, it would grow, but the wholesale buying off of, okay, we need to revamp everything we're doing for personal computers, and then client server, and then Webify. It just takes time. So I think it's more the uncertainty. What you've identified is the market's buoyant. It's holding up your stock price. If you're the CEO, you go, hey, my stock's doing fine. What my concern is they don't see the next wave of growth opportunities, because that's when you hire. The market's, the economy's booming. I just need to bring people in and train them and grow. And when there's uncertainty and you hold that back, then there's glitches in future economic growth.
Let's talk about AI and the companies associated with AI investment and the future and their valuations. Apple, well, not so AI as some others, but $4.1 trillion. That's what we're valued at in the market. Google, 3.83. A lot of that is definitely AI with the launch of Gemini 3, their latest large language model. Meta, owner of Facebook and Instagram, 1.68 trillion. Microsoft, associated with OpenAI, 3.6 trillion. NVIDIA, 4.5 trillion.
Used to be $5.
Used to be $5. I don't feel bad for them.
No.
4.5. We don't know what OpenAI would be valued at necessarily because it's
they claim
private.
$500 billion.
They claim $500 billion. Okay, it's surely in the multiple hundreds of billions. The question is, are these values sustainable?
Well, if you believe that near term, there's a wholesale adoption of AI, and so we need, gigawatt. I don't even like gigawatts to describe data centers. I'd rather.
Who knows what a gigawatt is? Right?
Yeah. What I like to say
it's a lot of energy.
AI really is the next best thing since sliced bread. But do we need 10 gigawatts of toasters? Probably not. And so that's the question of the day: is it is it a bubble? But I look at it: are they overbuilding? And one of the problems is they're building towards future demand, and every new technology gets overbuilt. It was DRAMs and it was fabs, and in the .com era, we built too many companies that shoved .com at the end of their name to go raise money, and so. Investors love new things that are growing, and they give them high multiples. And so a lot of this is being funded by the equity markets, by the stock market, and the ability to raise money. I mean, if you're an AI company, you could sell 10% of your company for $1 billion now, right? I guess that's all on paper. I like that people are talking about, types of chips, A100s and H200s and, NVIDIA chips, you'll know it's over when it's just kind of hidden, like when it's electricity. You plug it in the wall and you get AI. But for now, it's just being built. So number one, I worry about equity financing this because the stock market.
These valuations are unheard of.
They're unheard of. Number two, it's being built by circular deals, right? So NVIDIA gave, let's see, I got to remember my notes. NVIDIA gives OpenAI, or commits to OpenAI for $100 billion, who then commits to Oracle to buy from their new data centers, and then Oracle commits to buy 500,000 of NVIDIA chips. So, it's like AOL used to do these eyeballs for equity deals, right? When you grow by spending money off your balance sheet, it's suspect because it never lasts, right? It was vendor financing deals that Lucent used to do, right, for telecom equipment, and that I find the most disturbing, because is there real demand for AI, or is it just these circular deals that are funding it?
But wait a minute, there is real demand. I mean, we had an executive from Google in here not long ago who said, look, our biggest barrier to further growth is what he called compute. We just can't get enough chips.
Yes.
We just can't get it. And we can't get enough energy fast enough. So we could grow faster in terms of developing our large language model, but we just don't have the ability.
I don't think he mentioned revenue in that sentence either. He said, we want the compute to be able to offer Gemini to our, people that come for search or do queries or make funny pictures and videos. But, OpenAI has, limited $500 billion value. Their revenue is, in the
12 billion, I think.
12 billion,
something
and they're
like
losing 13.
I forget what it. Yeah.
Right. And so, yes, it's limited. One of the benefits that the industry has is there are two limiting factors. One is TSMC, the fab semiconductor maker in Taiwan. They're building like crazy in Arizona to try to, build in the U.S. But the reality of it is they're not slow walking it, but there's a limit to how many chips that they can produce at any one time. And they're the only game in town. That's number one.
Oh, Google is now making chips that that others are buying.
Yes, but TSMC makes them. So yes, NVIDIA and TSMC, and it turns out Amazon all have their, as far as I'm concerned, as far as I know, are all having their chips made by TSMC. There's only so many wafers that you can throw in. And by the way, the bear case for NVIDIA is Google, because Google makes their own tensor chips, or TSMC, but they have their own. Facebook now says, oh, we're going to buy these tensor, which is great because and number two is Google has their own data centers. So unlike OpenAI, who has to pay Microsoft and others for data center, and Oracle for data center capacity, and they go and buy NVIDIA chips at 75% margins, Google, can get cheaper chips, and they can keep cheaper data centers. And so what happens between that and an overbuild is prices come down. And that's good news for those who use AI, companies that are doing legal AI and doctors and all sorts of things. Walmart will all benefit when prices come down. That's what drives Silicon Valley, is the elasticity of demand. Cheaper chips grow. But not if you have to recommission 3 Mile Island to get enough energy to fund this. Remember Google for the last 20 years, they would build data centers next to waterfalls, right up in Oregon. They'd be near, because the energy is cheap. And they build in Texas, and they build in Louisiana, not in California, who it's off of solar panels or something. So energy is going to be a limiting factor, and TSMC's ability. So this could go on for a while, even though there's overcapacity. But I think when prices collapse, not collapse, but when prices start heading down, then those stocks start peaking, and some reality will return to the equity markets.
Just to give a sense of the magnitude here of some of the investment that's going on in data centers, Meta is going to build 25 new data centers across the country, different parts of the country, by 2028, I think was the date. And they're investing $600 billion.
Yes.
That's astonishing when you think about it. I mean, it's a huge financial bet from a company like this. Even a company as large as this, even one as successful as Meta, which has a revenue stream from Instagram and Facebook.
Yeah, so it's a big commitment. Some of that is to appease the Trump build in America. Let's just make it, because I think Mark Zuckerberg even admitted at one point, well, we just need to pick a number that's high enough,
satisfy the political gods.
The SoftBank, my son said, let's just pick a big number. Okay, so in 2028, which is not that far away, but nonetheless, those commitments can be cut back. What I find most intriguing is Silicon Valley, for the most part, was built without debt. It's even the fabs that were built by it was mostly built by equity and cash flow, and now. Facebook just did a deal for these data centers in Louisiana, $28 billion in debt. That's off of their books. It's someone else taking, even though it is their fab. There's some interesting accounting that goes on. Their accountants need to be given stock in Meta if it keeps going up. Oracle has $18 billion in debt that they've done, and there's another $38 billion coming up. They don't have the cash to pay for the $300 billion in commitments for data centers. So, I would like to say equity hurts, debt kills. We saw that in the financial crisis.
Sure, no question about it. No question about it. The flip side of your earlier point about the fact that near term, the demand may not be as great as they think, and that prices may come down because of the competition to sell to a demand that isn't as large. The flip side of that is when prices go down, the applications of AI become cheaper and therefore easier to implement. And so a washout at the top for the half dozen companies that are trying to build this super intelligence and to serve and to sell AI might be very good for the larger economy being able to take it and absorb it and improve productivity across the economy.
That absolutely, but that's again, I think that's a 5 to 10 year phenomenon. Look, there's a lot of adages that drive Silicon Valley, but my favorite one is the elasticity one. New applications open up to take advantage of the cheaper functionality. I mean, look at your iPhone. It's got I don't know. My latest one has 128 gigabytes or 256 gigabytes. That's $1 billion worth of chips versus memory if you go back to 1975 or something. You couldn't do an iPhone in 1975. Now we all have them because the cost came down. It'll be the same thing with AI. We'll have personal productivity that sits, Facebook wants it in your eyeglasses. Others, a little earbud or, maybe it's a little camera on your thing. It doesn't matter how it's delivered, but it will be a real-time personal assistant. That's Paul Gigot across there.
Your fading memory, Andy. I knew I met that guy somewhere, and it'll tell you who it is.
And then, what did I tell him last time? Because I don't want to look like an idiot this time when I'm talking. All that's going to happen. But the cost per token has to come down. And, in Silicon Valley, they're starting to talk about kilowatts per token. I've never heard anything like that before. And so that's a gating item. But it's going to happen, and the elasticity is going to kick in. But we don't know who the winners and losers are going to be quite yet. I've heard OpenAI likened to Yahoo. I've heard them likened to WeWork, 2.0, which is, the pioneer that goes out there.
Those are fighting words.
Those are fighting words, but they're both SoftBank investments. But think about it. It's huge upfront investment.
Right.
It's an equity market that lets them get away with it and, spend what you need. And at some point, reality kicks in. It always does, and it always will. And so I don't want to be holding the bag when that happens, yet I want to structure a portfolio that can benefit from the next 10 years. But what always happens is you get the 10-year benefit on day one, then the market comes in, there's weakness, crash is such a strong word, but there's a
correction.
A correction, thank you. And then the winners emerge. I'll remind you, Amazon, Jeff Bezos loves to talk about this. Amazon, their stock went from 113 to 6 after .com imploded. Yet they never missed a number. They, their business model, it all played out. And then, they had the benefit of data. They needed data centers from themselves, and they're expensive. They go, ooh, why don't we just rent these out to other people? And I'd like to buy. Now, of course, you could have bought Amazon 113 and still done very well.
Yes, you could have.
But when it went to 6, you could have done
really well. Yeah,
really well. So, and one more point about the stock market is, I always try to look in bubbles. The crypto bubble, and which is still happening, but maybe coming in. Where's the bellows? Like where's the hot air coming that's inflating it? And there's an interesting phenomenon going on with the Bank of Japan, because a lot of new capital has come into the U.S. markets over the years from the yen carry trade. Is you can borrow money, used to be for zero.
Cheaply in Japan.
Cheaply in Japan. Invest it, sometimes in bonds, but often in other things. And as long as the dollar was still going up in value, you can pay back the loan in cheaper yen. Great, that's the yen carry trade. It worked forever. Well, the Bank of Japan raised short rates from 0 to 0.5. All right, it's still 0.5, but long rates in Japan, the 10-year has been going up and up. It's now 1.9. I checked it this morning, 1.92%.
Seems low, but in Japan's modern history, high.
And we have an administration that thinks, wrongly, I will opine, that the lower dollar will help increase trade and help move things back into the U.S. U.S. increase exports by having cheaper U.S. goods, and that is so wrong. But nonetheless, it kills the yen carry trade. You need the dollar to keep going up. So as the dollar comes down and rates in Japan going up, I think that's what was behind the market sell-off a few weeks ago.
I see. So basically, just investment isn't flowing into the market from people. People were winding down their carry trade plays.
It happened in 2024. It's happening again. You never know. You can't track dollars as it actually, because it's all a mush in a market, which is how it should be. But keep an eye on the Bank of Japan. Keep an eye on rates, short rates and long rates, and that's going to tell you about the U.S. stock market. I think it's a big issue.
Well, that gets to the U.S. Central Bank, the Federal Reserve, and Donald Trump's significant choice coming up to replace Jay Powell as chairman. The list of people who might be considered. Kevin Hassett and National Economic Council, Scott Bessent, Treasury Secretary, says, I don't want it, but still a candidate. Kevin Warsh, former Fed governor and a prominent market analyst. A couple of Fed governors, Waller and Bowman. But I think it's probably Hassett versus Warsh or Bessent is my take. But okay, let's. The question is, are the markets going to in financial markets, bond investors in particular, but others, going to be unhappy if Trump picks somebody who is seen as essentially a rubber stamp for whatever Trump wants? He'll do it. Yes, sir. You want interest rates down a couple hundred basis points? Happy to do it. Yes, sir. I don't think that is going to sell on Wall Street if that's the kind of perception you get of somebody. And I think there is some worry on Wall Street about Kevin Hassett, who's, I think he's a good economist. I've known him for years. But his specialty, he did work as an economist at the Fed.
Yes.
But his specialty is fiscal policy and tax policy. There is a little bit of concern in the financial markets about Kevin Hassett.
Well, look, it depends what they do when they come in. I think the flaw in the thinking is that lower rates is going to stimulate the economy.
Well, and the Fed only has control over short-term rates.
That's right.
Not long rates,
That's
which
right.
is where the energy for growth comes in the economy, because that's where people borrow.
That's right. And it also is an inflation indicator. If there's fears about inflation, then the long bond backs up and long rates go up. And so the question is all of the choices that you mentioned are conservative thinkers, or so we think, and they're in that mold. But if they're sitting there saying we need to bring rates down, some of it is because Trump thinks, well, that'll make federal deficits easier to finance. Okay, well, yes, but not if inflation rates. And so the $64 trillion, because now you have to have $1 trillion question. $64 trillion question is, are these guys Keynesians, or are they true conservative free market thinkers? And
I would say that, and none of them are Keynesians.
Well, not if they're sitting there saying let's cut rates. And
okay, not on fiscal policy ananyway.
Right.
And and Kevin Warsh has written enough in our
page agreed.
to make clear that his root is monetarism. Bessent has picked up some of Warsh's arguments in our pages, and Kevin Hassett, I know from interviewing him over the years, is more in the Friedman school too. Yes. But the question is political. If Trump picks somebody, and we know from his raging at Jerome Powell, which remember, he nominated
Right.
the first term. He's raged at Powell because Powell didn't take dictation when it came to cutting rates. And so whoever gets in there in the first instance will have to have Trump on one side banging on him and the financial markets on the other judging his decisions based on, are they going to bring back inflation? Maybe.
Well, I'm going to tell you who's going to win.
The markets.
And it's the financial markets, because we saw a mini version of this play out in April. I happened to be sitting on a runway in Vietnam when the Liberation Day tariffs came and the markets freaked and Trump backed away. Somewhat, not completely.
Not totally.
But he backed up. So let's play out the scenario. Hassett comes in and he cuts rates a quarter, then another quarter, then a half a point, and on down. And the 10-year goes from essentially four now, to 4.5 to 5.
Right.
And the stock market goes from 46,000 to 42,000 to 35,000. They're not going to cut rates for long. And look, Trump's a real estate guy. Real estate guys love lower rates.
Yeah.
And if there's inflation, well, that's okay, because my
The
building
value of the building gets exactly.
right. But if you're making chips, or if you're and borrowing money, yeah, you want rates down, but you can't have inflation. So I think what's nice about capitalism is we have these checks and balances, not with the three branches of government, but with just the Fed and the president and the markets, and the derogatory, the bond vigilantes, and control things. And
What's wrong with vigilantes? I like vigilantes when it comes to the finance.
But they've been dormant. They haven't had a say. But then Liberation Day, they did have a say. So that's exactly, I think, in my opinion, that's what's going to happen. And maybe the sell-off a couple of weeks ago, maybe yen carry trade. But maybe it's a preview of, look, we'll take this down because we don't like the fundamentals and the threat of inflation. And I think that will put a damper. It's a governor, if you will, on that engine of the Fed. Doesn't mean they still won't do it. I mean, political pressure has, in the 70s, caused the nasty inflation. And anyway, that I like that stock markets exist just for that reason, too.
No question. Stock and bond markets are indeed a controller of sorts. Not always,
Yes.
and not perfectly, but they do tend to be a discipline on bad political.
Well, think about it. Instead of 534 votes or 70 million popular votes, it's millions and billions of transactions that take place, right? The Friedrich Hayek mode of that's where the information is in the price discovery of all of these trades. And so the market gets a vote.
Yeah, the market gets a vote. All right, Andy Kessler, thanks so much for joining us. We'll leave it at there today. A lot of fun, and look forward to your next column in the Journal. Thank you. And thank you all for listening here. We're here every day on Potomac Watch.